And it's a really important one that speaks to a topic that has impacted all of our lives in some way over the past year or two. The cost of living crisis and increased interest rates are affecting borrower affordability and driving down loan approvals. And for buyers, getting a mortgage has become more difficult. The supply of new housing may be slowing down, and the short-term loans many once relied on are not available. So what is being done within the FinTech sector to maintain access to loans? So to introduce our final panel, please welcome Parveen Kaur, who's a non-executive director for Innovate Finance and the Chief Customer Officer at Leeds Building Society.
Thank you, everyone. As they say, save the best for last, and that's what we're here for today. I've got this fantastic panel. I've already had the introduction, so I wouldn't spend time telling you about myself, and I'm going to open up to this incredible panel to introduce themselves because I can't do justice to their illustrious careers. So over to you, Katrin.
So good afternoon. I'm Katrin Herrling, CEO and co-founder of Funding Exchange. Funding Exchange has one mission in our life, and we've been around for about 8 years, which is to make it easier, fairer, and sustainable for businesses to access funding. And we've built technology that facilitates this by ingesting lots of data and ensuring actually that businesses getting access to the right form of finance as easily as possible. That's what we do, and as a result, we've been able to actually reduce the cost of finance for businesses we're working with by over 50%, by just giving them visibility around the different choices. And we've actually, over the last 2 years, evolved our business to provide our technology to funders to help them transform their own lending operations, not just from a perspective of being more effective, but actually also being able to demonstrate that they're compliant with regulations and the need to treat customers not just fairly, but to actively avoid harm.
Hi everybody, I'm Daniel Underwood. I'm Head of Credit Risk and Recoveries for LendInvest. LendInvest is a FinTech property finance lender and asset management platform, lending across a number of sectors, including bridging and development finance, long-term buy-to-let finance, and also homeowner mortgages in the specialist lending space for people with complex incomes. Supporting new and existing homeowners to access finance for the purchase and refinance of existing homes.
Hi everyone, I'm Pender from Fair for All Finance. Fair for All Finance is a financial inclusion organisation set up to grow the availability of affordable credit, specifically looking at how we can support the growth of credit unions and community development finance institutions. Also how we can work with mainstream lenders to improve the access and availability to appropriate both credit, savings and resilience products. And lastly, to pilot new and innovative products that will help reach people in vulnerable circumstances. Our segmentation work, which we've just published, shows that there are about 17.5 million people in the UK who are either financially underserved or who are excluded. So delighted to be with you all here today.
Hi everyone, Mike Bristow, CEO and founder of CrowdProperty. I think it's a sign of maturity of the alternative finance lending sector that we're sat last at IFGS, right? Many years ago, alternative finance was very much first on the agenda. Now it's last, and I think that's because it's well established over many, many years, disrupting lending and opening up lending and finance channels to many across many different asset classes and segments. Our mission is to unlock the potential of small and medium-sized property developers who struggled to raise finance for good projects, and that had a major knock-on effect to house building in the UK and the implication on spend in the economy also in the UK. We've expanded internationally as well.
Thank you, Mike. As we've all seen of late, the market conditions are pretty challenging at the moment, and over 60 subprime lenders have withdrawn and exited from the market since 2016. And the cost of living crisis is affecting borrower affordability and driven down the loan approvals. It's now a very hard time, and probably harder than the times in the Victorian age when it was really hard to get short-term loans, and that's something that people relied on as a source of lending and credit. Kate, my question to you, what do you think what are you seeing in the market at the present, and who are the lenders who are struggling at this point in time, and what do you think we should be doing to support them in this cost of living crisis?
Thanks, Parveen. I mean, I think it's a really difficult time for many lenders in terms of wanting to help people who legitimately need a short-term, small-value loan to really get them through. We've seen lots of pressure in terms of the affordability calculations that they're having to make, and many of them are sensitizing those calculations, and that's meaning that they're making an assumption that someone's costs are going to go up and that loan might not be affordable. So there are many more declines than there once were. I think the thing that lots of people talk to us about is the relevance of consolidation lending, where we can help someone who's got perhaps high-cost debt and that their debt servicing costs are taking a lot of their income every month. And we're reprofiling that loan possibly into a longer term and definitely into a lower interest rate. For example, the sorts of things offered by credit unions in the UK, those can be really transformational. What's been really interesting for me, and perhaps relevant to some of the FinTechs who've been here today, is that there is a technology gap in serving those people well. So really small lenders, right through to the mainstream banks on the high street, all say that consolidation lending is a great answer in the cost of living crisis. But almost all of them say that doing the underwriting is quite hard. And what would make it much more straightforward from a risk perspective is if they could pay the debts of those customers directly. But it's not that sophisticated in terms of what's sitting in the back office stack for most of those lenders. There's not an equivalent that's readily available in the same way that transferring your current account, transferring your utility provider looks like. And the obvious exception are balance transfer credit cards. But not everyone's got high-cost debt on a credit card. So there are some innovation gaps that we'd really like to help solve. So with some of the funding that we have, we're going to be running innovation sprints on consolidation lending and other products that are really pertinent to the cost of living crisis. It'd be really great to see some new innovation come from faces in the room and those who've been here today to try and tackle that one.
Thank you, Kate. Katrin, if I can bring you in, you've been providing the technology platform to FinTechs and the financial services industry to support lending to smaller borrowers and largely across the sector. What's your take on what the market could do more to support in the current cost of living crisis, and more broadly in terms of responsible lending?
So I think in the commercial lending space, which is where we've made our home, one of the biggest challenges is actually to lend to those micro businesses that are either earlier stage or have just chosen to be family supporting businesses, or to not have an ambition to grow to being £1 million businesses. And the challenge you have there is that assessing businesses for lending is just very expensive. And so what we've always seen is that those micro businesses have found it harder to access finance. Now, what the cost of living crisis has done in the commercial world is actually these businesses often are more under pressure because their commercial operations and their family income are often quite tightly linked. And just by being smaller, they tend to be much more exposed to any swings in revenue and margins. So the exposure on the micro segment, and that makes up probably, there's about 85% of businesses in the UK that make less than 200k a year in revenues. So it's a large, large proportion of the businesses in the UK. And so what this has done is actually it has reduced access to finance for this segment of micro businesses because of the concerns that lenders have about the stability of these businesses that have these intertwined finance arrangements. And many of them have accessed finance from the government during the COVID crisis, which is still debt that's sitting on their balance sheet and will need to be repaid at one point. So you have quite a difficult structural environment out there for small businesses to access finance. Now, one of the contributions, and you asked me what can we do, so one of the things we are doing is actually making it much simpler and easier for lenders to assess these businesses in terms of their eligibility and affordability for lending solutions, and thereby drastically recosting the upfront cost before you're actually making finance. And what that does, and we've seen the evidence in the sector, is actually brings down viability in terms of the smaller loans become viable because the cost that you have in unlocking the finance is lower. And so one of the contributions that we bring, not just to big banks who are working with us to transform their manual processes, but also even more traditional lenders like the asset finance sector, is enabling them to bring their own costs down and increasing their visibility into the trading performance and the repayments performance of these businesses. So by using data to the benefit of our lenders, we're actually enabling them to unlock more finance. And we've seen how the performance of these loans actually has been incredibly strong, even during these challenging times. So I think the use of data and the reduction of costs is always a good starting point if you want to push down into the more marginal segments, and that's exactly where we as fintechs excel.
That's fantastic, and I think that supports various businesses and not just the lending and the borrowing market. Daniel, if I can come to you in terms of LendInvest have launched a residential mortgage product specifically for key workers and young professionals. Why is a specific product necessary for these groups? And could you talk us through a bit more details on why do you think this is important to make it more inclusive?
Sure, yeah. Kate touched on the point around affordability assessments, and I think the biggest challenge facing mortgage borrowers, and probably most of us, is affordability of mortgage payments. And I guess historically we're not technically in a high rate environment. I think back to when I started in financial services 25 or so years ago. Base rate at that time was bouncing around between 6 to 7.5%. I'm sure there are plenty of people here that can remember even further back than that when it was higher. And yet you didn't have the same problem then in terms of mortgage affordability. And there are a couple of reasons for that. One of them is that if you look at income to house price ratios, they've changed massively over that period. So incomes haven't kept pace with house price growth. At that time, income to house price ratios were probably 2 to 4 times, and maybe in central London as high as 6 or 7. And you play that forward to now, and actually income to house price ratios are in central London anything up to sort of 12 times or higher. And if you're on the wrong side of a gender pay gap, it's even higher than that. So you have that challenge around rising house prices and incomes not keeping pace, combined with the current cost of living crisis that we're also talking about. And you multiply those factors and you've got issues with affordability. So to do that, from LendInvest's perspective, when we launched into the homeowner space, we looked at areas of the market that were underserved. And a couple of those are particularly areas where people have complex incomes. So the two that you picked out there, key workers and qualified professionals, typically find with, say for example, key workers, that people will have uneven shift patterns, they will do vast amounts of overtime, and you go through a normal mortgage process, perhaps with just a basic automated decision, and most of that is based on basic income. So what we wanted to do was to be able to utilize technology to improve the affordability process, but also have an individual assessing somebody's complex income. So looking at things like overtime, additional income, complex shift patterns, and actually making sure that as many people as possible can utilize that additional income to pass through affordability assessments. So I think it's important to also have specialist lenders in that space, so you're not just relying upon very, very straightforward assessments of people's incomes.
Daniel, that brings me to the next question around unconscious bias. So you spoke about, an automated system bypass to have more affordability calculations and make it more inclusive for the underserved. But do you think having automated systems bypass any sort of unconscious bias. I'd like to bring you in, and then of course, Katrin, your views on it as well.
Yeah, I think statistically speaking, I guess people are inherently have a level of unconscious bias. That's just a part of human nature, that we base decisions upon prior experience and personal opinion. So so the first thing to do is to acknowledge that there is a problem with unconscious bias. It's something that we have to be aware of, and we have to look at ways to mitigate it. One of the ways that you can do that is through automated decisioning processes. So you strip out the human element and you base decisions upon data and system rules. And that can remove an element of human interaction that can create some unconscious bias. But you also then have the problem that automated systems through either AI or machine learning can effectively exacerbate the problem of unconscious bias if you don't have a proportional data set that you're basing your decisions on. And also you have to look further back at the teams that actually built the automated systems and whether they were particularly diverse and representative of the areas that you want to avoid bias.
It's even, you could add to this, even if we assume that we can use data in a way where rule sets are not biased, the data itself actually often is biased itself. So one example of this is that in our space, we've seen actually during the COVID times that there's been quite a significant shift towards including personal credit data in the assessment of small businesses. So looking at the director's profile. And there is actually a correlation between outcomes from lending and the personal profiles of these directors. However, if you then segment down the director data into different segments of the population, you will automatically introduce a bias because there are ethnic minorities that live in certain areas that will be penalized in terms of their background, where they live, et cetera, in terms of the scores that are being presented. So it's even where we're able to exclude from rules-based engines or AI biases that clearly do exist. It's even the data itself that introduces biases. The outcome for us has been over the last 2 years as a result of what COVID has done, because we're seeing reduced lending in the micro sector being the really hardest element to lend to, is that those who are suffering are really ethnic minorities, female-led businesses that are often finding it much harder to access finance. Now, there is a train of thought that actually, well, this is why we have consumer protection coming in and we want all to have fairness in lending. The argument here actually is also we need to protect these more vulnerable groups that are at the smaller end of society by ensuring affordability is evidenced. As you were talking about, affordability is a huge topic under consumer duty. However, even that starts adding then outcomes that are again taking access to finance away from some of those more marginalized segments of society. So even where we're putting protection in, the ultimate outcome can very easily become that actually some of the segments we want to enable to access more funding are actually seeing reduced access to finance. So it is a really complex problem. And as you say, I would end with the same words that you started with, consciousness and awareness of the challenges and the ability then to try and find strategies to work around it. It's the only thing we can do.
Yeah, and it's not necessarily about having fairness in benchmarks so that you have the same rule for everybody. You know, that's effectively fairness, but actually what you need is equity, so equal representation of different segments. So actually you accept that there are differences in either a population or a segment, and you adjust your lending decisions appropriately to cater for all markets.
I'll hold everyone's thought on consumer duty because that's a topic I'm pretty passionate about, and we'll come back to it. And what to bring Mike into the conversation. Mike, we spoke about that housing supply is down, and some of the lenders in the market have been withdrawing from second homes and are focusing purposeful lending towards first-time buyers. What are fintech businesses such as yours doing differently to bring finance into the sector to improve the demand and supply equation in the market?
Sure. I think fundamentally it's about cost to serve and the efficiencies that we can deliver through technology on that. But also, it's not all about technology. It's thinking about the customer and reacting more nimbly to that. So, sort of insights into the market. One thing the UK is spectacularly good at doing is building 200,000 homes a year. There's just a fundamental problem with that, is that we need 300,000 homes a year. And if you sort of zoom into the makeup of that, it's that in 2008, purposefully chosen just pre-GFC, 30% of house building was produced by small and medium-sized developers, and they're really important, okay? Wind forward 9 years, so post-trough after the GFC, about 10% of housing supply was from small and medium-sized developers. And that's a sort of a fundamental problem, because large developers who made up that gap need fields and fields of often reclaimed greenbelt land to build 200, 300, 400 homes. A small property entrepreneur can look out of any window and say, I could put 10 homes there, 2 homes there, 1 home there, etc. Why? Well, fundamentally, it's because underwriting a property development loan for £500,000 is not 1/100th of the effort of underwriting a £50 million property development loan. So you've got to get super efficient at it. So in fact, the whole market, the whole sector was underserved by major financial institutions because of fundamentally a cost to serve piece, right? And that's really, because of that cost to serve expense, the research and understanding as what the fundamental customer needs was not being focused on, right? And so that's what we set up our business to do, to underpin all of that with technology, to say, right, let's serve them better, more efficiently, and we can serve that market brilliantly and take that market share and unlock the potential of small and medium-sized developers, and hopefully build 300,000 homes a year. We didn't this year, we built about 170,000. So we didn't even hit our 200,000. But and that's fundamental, because we need homes to live in. And as I said, we need spend on construction. And residential construction is about 2% of GDP, right? So you build half the homes, that's minus 1% of GDP. That's recession dragging, right? You double the amount, or add 50% of the amount of homes, that's 1% of GDP into the positive, a 2% swing, right? This is meaningful to the economy. So we've got to find ways to unlock the potential to serve that market in an efficient way, because otherwise it will not be served, right? And that's the entire predication of our business.
Yeah, and I hope there are people listening into that, because it is at the end of it a demand and supply proposition, but to bring, as you said, the root cause may be that the number of homes is less, but the finance being the biggest, if not the most considerable impediment to that growth, is something that we've got to support to try and bring in different channels of funding back into the segment and the sector. Thank you for that. Kate, I'd like to bring you in to talk a bit more about the measures that impact lending practices, and how do we ensure that the broader community is being served and supported through higher financial inclusion, especially the underserved. So you've been quite passionate about trying to support the underserved. So maybe you can talk to us a bit more about that.
Yeah, happy to. So one of the things that we've been doing for the last year is running a pilot of a no-interest loan scheme. And this is a product that's available internationally. You may have heard of Good Shepherd in Australia, who've offered it for quite some time. In the UK, it's had sort of a patchy offering in a few places. So we are really pleased to have run an initial proof of concept in South Manchester, and we're now running a pilot which will slowly scale across the UK. But to your point about underserved people, Parveen, we're really trying to help those who all lenders have said no to. And they've said no for reasons that are quite hard to argue with. They're often people who have no or a really thin credit file. Sometimes they're people who've got a really massive problem with affordability. But in almost all of the case studies that we've got thus far, there's a really good reason to give them a small loan, where there's a societal benefit. For example, someone who could take a job in an adjacent town if they could afford the car repair, that would mean that they could drive to it. You might have seen in the last budget, the government's changing the policy about nursery fees. That's not immediate, and so some of the initial no-interest loans that we've put forward have been for women who needed the £1,000 to pay the nursery fees up front before they took the job that was going to help them get back to work. So some really kind of interesting dynamics about why people haven't been able to get the credit that they need just to get on with their lives. We're working with both credit unions, community development finance institutions, and a couple of social fintechs on this. And what's been really surprising to me has been how low the bad debt is, because that was a big part of our test, having a bad debt guarantee to sit in behind that lending. And it turns out that if you do that lending well and you help change the circumstances that that person is living with, and you couple it with financial capability coaching, which JP Morgan has come in alongside to help fund, you can really make a big difference in someone's life. Some of those customers, in particular those who are served by credit unions, have started savings at the same time. And those of us who are kind of economic purists might think that that's a really irrational thing to do. Like, surely you should pay off the debt first, right? Because that's going to clear up your credit file and you'll be entirely free of debt. But for some people who've never had a savings habit, just putting an additional £1 or £2 aside a month is a really transformational experience. And at the end of the year, they come out being able to say, I've got this pot of money that I never thought I'd have. And it changes habits in a way that's really exciting. So it's at an early stage at the moment, but we're really excited about it as a potential opportunity to help people who would otherwise be excluded entirely. And for some of them who've now already paid off their loan, they've been able to go ahead and take out a second loan with the lender that gave them that no-interest loan. And that second loan has some interest attached. So it's proving itself really effective for the lenders as well, because the kind of lifetime value for the customer is starting to be writ. It might not be writ large immediately, but that potential is there. And it kind of validates some of what we saw in the segmentation work that we published last year. So quite a big chunk of people in our segment model are what we called unsteady starters. So people who don't have a really robust and elaborate credit file, who perhaps have, to Daniel's point, slightly erratic earnings. They might be on shifts, and for whatever reason, they haven't been able to build up that history with a lender. So this is a product that we're helping, will hope change some of that. Some of our broader work on financial inclusion and helping communities in need has really been about providing both capital and capability funding to credit unions and CDFIs to enable them to grow their lending and to do it in a way that's both tech-enabled and kind of more closely speaks to the community that they're serving. So they're small but exciting steps, and we hope to kind of use a test and learn process where we pilot specific things, publish the learnings, and then make the case for the kind of ongoing funding arrangements to enable them to be scaled up beyond there.
And what do you see as your biggest challenge in that space?
I think the biggest challenge that I would see is lenders' perception of the risks. So within the no-interest loan scheme scenario, we had quite a lot of hesitation for lenders wanting to do that with us to start with. And, frankly, we were offering a Treasury-backed bad debt guarantee, JP Morgan financial capability coaching, contracts that could be extended if they were successful. But two things really changed lenders' preparedness to work with us. One was we got into the FCA regulatory sandbox for the no-interest loan scheme, and the second was that we started to publish findings from the proof of concept, where one lender had a go and could see that it was going to work. So I think the kind of innovation system and the way in which we enable lenders to test new things where they're trying to help communities that have been underserved or excluded, that's something that we need to get slightly better at. And it's a really difficult point in an economic cycle to be asking lenders to take more risk. We get that. So that's why some of our work in the proposition sprints that we're kicking off shortly has literally been to sit with people and say, what has to be true if you're going to try something different with this community? Our suite of tools currently involves lending capital, a bad debt guarantee, some fees for lending, the involvement of the regulators. What else do you need from us to enable you to do something differently?
Fantastic, and good luck with that.
Thank you.
I'm coming back to my favorite topic, as I said, consumer duty. And with consumer duty coming into force pretty soon, and the FCA has indicated that some organizations are behind their planning and would probably not be fully ready by July. Daniel, if I can bring you in terms to talk us through what you think are the big changes that we would need to make to get the sector ready for that change and compliance by July and beyond?
I should start by saying I'm fortunate not to be the consumer duty champion for LendInvest. And that's nothing to do with me not believing in the duty. I absolutely do, but I'm aware of the challenges that are there to actually implement the consumer duty. So it's a huge piece of work for any business. And I think if I can point to the FCA's recent review of board preparation on fixed regulated firms, there are a few things that stood out there in terms of challenges that institutions were facing in potentially not being ready. One of the key ones was not having a prescribed champion of the duty within firms, so not having a key person at a very senior level whose responsibility it was to deliver. And then also, I think to some extent, the consumer duty builds upon practices and culture that companies should already have, but there is a huge step change in what the regulator expects to see. So you cannot just point to existing processes and existing systems and say that we are already doing these things. The regulator wants to see a big shift in change and consumer duty embedded all the way through products, services, policies, right down through into company culture. So it's a huge piece of work, and I think perhaps some of that is underestimated to an extent where people feel that actually a company is already doing a lot of those things. But actually, as I said, the regulator expects people to go much further than that.
Yeah, including the substantive outcomes evidenced for just better assurance and attestation is going to be a challenge many companies would have to comply with to satisfy the regulator in terms of providing better and tailored outcomes for customers, especially with those of characteristics of vulnerability. And so, Katrin, do you want to bring in your views around consumer duty, and what do you think that organizations should be doing to address and support customers with vulnerable characteristics and make sure that the policies and the procedures, and including the technology, is not designed in such a way that doesn't support or in a way kind of becomes an impediment to the vulnerable customers?
Just for those of you who are not as familiar with consumer duty as we are up here, because we live it every single day. So there's probably three elements to consumer duty that are relevant to understand in terms of the shift that consumer duty is requiring. Where before it was sufficient to treat customers fairly, which allowed you to be inactive and not do anything. If then the outcome was not good for the customer, that was acceptable. The first shift is that you have to proactively avoid harm. And that means not doing something isn't good enough. And that is not just at the point where you're, for example, offering lending, but it's even if somebody in your existing in life portfolio is no longer on a suitable product, you are expected to avoid harm. Banks are not proactive. Banks don't necessarily know how to find customers that are no longer on suitable products. So that's just one of the challenges. The second challenge is actually that you need to evidence this. So if you want to evidence practices, doing this by having somebody in frontline actually call and have a chat is often not good enough. You then actually need to be able to evidence what's been discussed and what other product has been provided and how suitability for that new product has actually been demonstrated. If you've done all of this in terms of avoiding harm and being able to demonstrate that you've proactively reached out to customers, You then have to imagine that you have to do this for customers that can number hundreds of thousands. So there is no manual process that's going to allow you to identify which customer may no longer be on a suitable product. But you need to start having a system that allows you to be alerted if somebody is about to be on an unsuitable product, experience harm, and you need to evidence the actions there as well. So these processes of identifying customers and ensuring these processes are actually happening are not something that today exists in these banks. So the challenge is huge. It's easier for a fintech that's digital at its core to develop rule sets and use data and be able to proactively identify customers where an interaction is necessary to avoid harm, than if you actually built a bank that has customer data in 100 different places. You don't really have a way of, well, banks are getting better at putting data into one place, I must say, but where you don't really have a way of proactively engaging with the customer base, and you have absolutely no way of ensuring suitability of products. So the challenge is huge. What we're seeing is that the traditional players that have not built data-centric models are really, really struggling. And so this is, I think, a fantastic way of the fintechs actually coming in and supporting banks and lenders as they're now forced down a path of digital transformation to be able to deliver. And so what we're seeing, yes, there's lots of efforts in terms of trying to validate the resources that are within the bank. But the actual challenge of at the core, you need to be digital. At the core, you need to manage your customer data. You need to be able to use it in a sensible way. That's the bit that, to me, is the fundamental challenge that the banks are struggling with. And if you put this into a frame of cultural change that's necessary, where inactivity was always better than actually proactively doing something, because if you didn't do something, you could never go wrong. Now, suddenly, that's no longer good enough as an approach. You're not just having a technology challenge, you're having a massive, massive cultural challenge. What I think is what I admire is the FCA coming out and actually saying, this is what we expect of you, and we will measure you against these expectations. It's very, very different from historic regulatory approaches that are much more tick box exercises where you can create a paper trail and that's good enough, you've done something, and there's a process that you can evidence. This, as you say, it's about outcomes. And evidencing outcomes for customers, it's not a tick box exercise at all. I'm hugely supportive of the direction of travel. I do think it's going to take years for the banks to get there. So July 1st, we're going to see some FCA reports coming out saying, guys, you're miles and miles away. I do think that the collaboration, and we're seeing this in our own world, between fintechs and banks is going to be part of the solution.
Yeah. I personally am looking for a number of solutions. If anyone has a good solution to offer in my day job, I have the privilege of managing vulnerable customers for the society, and I'm definitely looking for solutions. But to your point, Katrin, it is a cultural shift, because while we have been providing great outcomes to customers and we thrive on that kind of advocacy and customer loyalty, but to be able to evidence it in a substantive way and a proactive way is going to be a challenge, and hopefully the fintech community can provide a more data-backed, technology-backed solution, because trying to do that evidencing at a substantive level through a manual checkpoint or a dashboard is never going to be sustainable. So definitely an area of challenge and opportunity. Yeah. Mike, if I want to bring you into this conversation around consumer duty and responsible lending, while you did mention that funding is one of the biggest challenges, where else do you see the biggest challenge, and what do you think that the government or the regulator can do to help support that funding in the sector?
Yeah, I think, I mean, specifically around consumer duty, we operate a two-sided marketplace. So predominantly we serve property developers, which is a commercial lending opportunity. But we grew up as a peer-to-peer lender, and we have thousands and thousands of investors on our platform. And that's now a minority source of our capital. We've got many, many different sources of capital, and actually today we've announced the British Business investments coming into our platform and investing. But consumer duty fundamentally affects those investors. We have retail, restricted investors. And so we need to apply all of those factors on both sides of our marketplace, less so on the lending side, given it's commercial related, more so on the investor side, given we are dealing with individuals. And that is quite rightly an area of great scrutiny for the FCA and around consumer duties. So, that adds to our the sort of the thought process we need to put into our business for 1st of July.
Fantastic. One last question, which I'd like to open up to everyone before we close this wonderful panel. Do you consider buy now, pay later a responsible lending practice? And if yes, what caution would you advise the customer? Daniel, can I start with you?
So I think there is a place for everything, I think, in financial services, and buy now, pay later has its usefulness. Obviously, there needs to be control and regulation around lending practices, and we've seen that with a number of different innovations in the finance space over the last few years. But I think there's absolutely a place for all types of financing. And without passing it on to Kate, I know we've spoken previously around some of the education around how APRs and things like that work, and I think there's a lot of misinformation around some of the costs associated with very, very short-term finance, which I think is important to recognise.
Kate?
Thank you. I think buy now, pay later absolutely has its place. In particular, I think some of the use cases around people who can't physically get to the shops and who don't have an enormous credit card balance to enable them to wait 30 days for a return, all of those use cases are really powerful. There's lots of evidence that people are getting into trouble with buy now, pay later, that the late fees that are kicking in are problematic. We're seeing demand for really small consolidation loans because people are trying to consolidate tiny buy now, pay later things that looked okay at the time and then have snowballed into 5 or 6 things that end up being quite big. So I think there's something about making sure that customers really do understand that it's credit, and there's lots of evidence to suggest that they simply don't always know that. I think there's also something that's slightly contrary to what we've heard a lot of today, and that is pace. So there's quite a lot of research that shows that financial education, financial literacy are really important ingredients, but they get quite quickly derailed and gazumped by really impulsive behavior. And there's something about getting the amount of friction right that for me is troubling in the buy now, pay later space, where it can be the perfect thing for the perfect product, and yet. So I think there is a version of it that I'd love to see, but I'm not sure I've seen it yet. I'll stop there.
That education piece is really important. There could be huge improvements in financial education in the UK, which I think would help with people understanding how these products and services can actually impact them longer term as consumers.
I fully agree. Katrin, any last words from yourself or Mike?
Yeah, well, I will convert this question into our space, where in the commercial lending space, there's certain products considered regulated and others are unregulated. They behave very similarly, but merchant cash advance, for example, is not considered a lending product. And so hence, some of the normal consumer protections are not coming into play. So affordability, consumer duty, all of that does not apply to some products that look and feel just like lending. My view is, yes, there's diversity of products, but protection around all of these products for the consumer should be the same. There's no reason why there are products that are considered unregulated versus others that are actually regulated if they do the same thing.
Thank you.
I think it's brilliant how consumer needs are served quickly by innovative fintech businesses, and I think that's a huge opportunity and a testament to the overall fintech movement. However, the two fundamentals are, number one, the borrower, in this case, understands the product, and number two is it's responsible lending, to bring full circle on the topic of the debate. So.
Thank you. With that, I'm going to ask the audience for a round of applause for this fantastic panel. Thank you.
Really well done.
Thank you very much.
Thank you so much to